Credit score is extremely important when it comes down to getting financing from a bank. As far as having a minimum credit score, I've had a client get approved for a decent rate with a 580 credit score. And it's because that client did not ever make a late payment on any of their debt. It was just that they had a small collection of medical debt and they're almost maxed out on their credit card. So technically there is a minimum. I mean, anything under 600 may be challenging to a bank to get you that mortgage. But as long as you don't have a lot of late payments and you have a credit history, you should be okay. Now, if you have a lower credit score, then your interest rate is going to go higher. Because remember, it is all risk-based. So somebody with, let's say, a great credit score is going to get the best interest rates. Somebody with a lower credit score, they're going to get a higher interest rate because that money is much more expensive to come. And remember, banks have underwriters that review the risk of the file. So if they're looking at your credit score, not only do they look at your credit score, they're looking at the content of your credit. Why is it bad? Why is it low? Is it because there's no history? They're looking at the entire picture. And my suggestion is to always check your credit and have those apps so you know the algorithm of your credit score before you start having that pre-approval done or applying for a mortgage. In my opinion, if the buyer doesn't really like the rate they're being offered from the lender they're talking to, I think it's very wise for them to start shopping out and talking to 3-4 local mortgage people, right? Because I think mortgage folks will try to do their best to give the buyer the best rate. But sometimes it's not in their ability because remember, most mortgage folks work for large institutions. So it's hard to negotiate rates. A lot of banks will do a float down. So if you lock in a rate today, let's say at 3%, and prior to closing rates drop, they may have the ability to float the rate down if it drops. So in the beginning of the process, talk to your mortgage person and ask if they do float downs on their mortgages. And most banks, especially in the New York City area, they will float the rate down if it's dropped before the closing. So if you don't like the rate that you closed with, I think refinancing is a great strategy to lower your rate if you weren't happy with it. Because remember, you do not incur the same closing costs on a refinance as you did when you first purchased a home. You don't have to pay the mortgage tax, the transfer tax, and the mansion tax. So if rates have dropped after you purchased your home, it is a great idea to refinance because the cost involved could be astronomical. The pre-approval, in my opinion, is the single most important piece of paper to obtain before you start looking for a home, because that assures you as a buyer, a bank is ready to stand behind you and give you money when the time comes. The pre-approval letter pretty much states, the bank has viewed your credit, looked at your assets, and looked at your income. And those are the 3 main pieces banks look at when they're giving you money. So the pre-approval assures the buyer that they can actually get a mortgage when the time comes. The numbers are pretty black and white. They're going to say our debt to income ratio is 50% of your gross income. Now, that doesn't mean if a bank approves you for 50% of your gross income on your mortgage payment, you should go out and spend up to 50% of your mortgage payment. As a matter of fact, I highly advise you not to do that. I think the average rule should be 28 to 35% of your gross income for all of your debt. Just because a bank approves you, you should not over leverage yourself and go to the max capacity that the bank has approved you for. but that pre-approval does give you a good sense of what you're able to borrow, and that when the time comes, the lender or the bank is ready with their bag full of money per se. A pre-approval does expire. Every pre-approval with every bank has an expiration date, because you remember, the bank is running a credit report. That credit report is usually good for 3 months. So every 3 months, the mortgage banker, the loan officer, they're going to do that review again to issue a new pre-approval. So it is important to constantly update the loan officer you're working with, especially when you get closer to that 3-month mark. There are a lot of tips on what you have the ability to afford when buying a home. My advice is never to over leverage yourself, right? New York City and New York in general has the highest closing cost per purchase than anywhere in the country. You must be prepared to come out of pocket if you're buying anything but a co-op between 3 to 6% on the sales price. A lot of folks don't realize that when you buy a home, you cannot finance closing costs. If you're buying $1 million home and you're putting down 20%, aside from the $200,000 that you have to put and give to the bank or the sellers at closing, you have to write a check for the balance of the closing cost. And remember, closing costs are not something that you can negotiate, with the sellers, because you're paying it mostly to the city, state, and county. You really have to be realistic with yourself on what you have the capacity for. So seller's concession is a great way for a buyer to save on closing costs, because what you're essentially doing is you're asking the sellers to contribute to your closing costs. Because remember, closing costs must be paid in cash at closing. So you're writing a check to the city and state and the municipalities of where you're purchasing the home, and the sellers can actually contribute to that with a seller's concession, where they give you a percentage, usually up to 6% and not more than 6% of the sales price. In New York, there's something that is extremely complex, which is called a purchase SEMA, where the sellers gives you their collaterals from when they purchased the home, so that you can avoid a portion of the transfer tax to New York State. And that's something that strategically the attorneys work out in New York City. And that's called a purchase SEMA.